Welcome to Shark Cap Table Fast, the 1-minute deal maker for sellers and buyers of equity that helps you keep your arms and legs. Today, we are going to analyze a typical telemarketed opportunity. It could also be done with a limited partnership or some kind of a private placement where you're buying shares, or even a crowdfunding unit deal. So what we want to do is, you're going to see nothing in this area right now, and that's the way we want it. It happens to be set up with hide all help and no tele deal. We are going to have to ask it to do a telephone deal. So some things are going to come up here, but let's go immediately down to the bottom of the page. All right, so the phone rings and you've been offered a private placement shares in Whizbang Corporation, a consumer products company. Do you hang up or listen? Well, we generally recommend you hang up, but it's also instructive to understand what a bad deal is like. So try asking for the selling brochure and then use Shark Cap Table Fast to analyze the deal for fairness. So the first thing we need to do is we need to assemble the deal data. And I've already done that for you. A typical unit price is 10,000, 7,500 shares in a unit. It translates to $1.33 per share price, 40 units in the offering. And you'll have to do a little digging because you need to find out how much cash the promoters have actually put into the business. They probably won't tell you. They'll try to puff up the additional value. Oh yeah, we got 28 patents and they're all worth $17 billion each. Ha ha. So we have a total Whizbang valuation, and I'm just throwing these numbers in without knowing what really Whizbang is all about, but I'm going to make it lower than whatever they tell me. You can get the number of shares outstanding by asking or reading the offering prospectus. And don't forget to look at the options, warrants, and convertibles and determine how many shares will be issued based on full conversion. Go out 4 or 5 years and make sure you get them all. This number here is, of course, the total shares offered for sale. This is the total offering price. Actually, it's the total offering amount. They're going to tell you that they're probably going to sell this business in year 2 for a whopping $10 million. All right. So now we need to actually do something by setting the red drop-down B to show helpful hints. Let's go up there. There's B, show helpful hints. And we also have another thing here which is red, and it says analyze tele deal. Zero the royalty spinners and eat Shark Cap Table Light, Section D. Select equity from drop-down, return to fast. Okay, so we're going to come down here and find the tab that says light. We're going to come up here to Section D. We're going to drop down and we're going to... but we forgot to do one thing. I told you to do this. Yes, we did zero the royalties. Even if we had royalties here, they'd still be zero, but we need to take this number out as well. So now we got the equity and everything is copacetic. Let's go back and see what we're going to do next. So let's go back to the Shark Cap Table Fast. Now, we are showing what you need to put in. So these happen to have been done last night when we actually had the deal. But here's one we need to adjust. So number of shares outstanding now are 3 million. And by the way, I'm going to move these little guys off to the side so that we don't get in the way of them. We can't quite get the options exact. That's about as close as we can get. So now we put in $4 million. Let's crank up here and go to 10 million. And by the way, before we forget, let's make the 2-year sale price. Let's crank this up to 10 million and give them the benefit of the doubt. And now the other thing we have to do is, this says that we have a share offering price of $1.33. So we've got $1.60. This is the unit cost per share. So we need to crank this down until we reach $1.33. Won't take long. There we go. That's pretty close. Yep, that's the closest we're going to get. Well, now we've actually entered the data and structured the deal. So let's see what we've actually done. As a whole, or a group, the unit holders will get, based upon a $10 million sale in year 2, they will get 1.7 times their money back. That is a 31.9% internal rate of return. Voting control rests firmly with Whizbang founders, and if you look at the total diluted ownership stakes, you'll see that the Wiz options are significant with 23.6. The founders, which have shares, are 69.4, and the lowly little units only own 7%. Now, on the face of this, it doesn't sound all that bad, but let me tell you something. A couple things are sure to happen. They're not going to sell it in year 2. They're going to sell it in year 4. Look what happens. It stays the same for investment multiple, but of course, internal rate of return is a time-sensitive metric. So if you lengthen the time before you sell, you lower the internal rate of return. Now, the next thing that's going to happen in one of these deals is they're not going to get 10 million, they're going to get 6 million. Now let's see what's happening. Well, whoopee-doo. You barely get your money back, and you have a 1.1% internal rate of return? Well, I don't think so. That's not such a great deal. Now let's go down and read the 4 key questions that I always ask at the bottom. Are you really going to see this exit value? And what about the risks ahead? Well, we're not going to see 10 million. We're going to see 6 million or worse. Haven't the founders and the option holders sucked too much out of the deal for hardly any cash? Well, you bet your bippy they have. Look at this. Between the two of them, they own about 93% and you own 7%. You've put up $400,000. Look at the returns these guys are getting. They're 10 times the amount, of course. Your return in this case is barely equal to the amount of money that you put into it. So that's not red hot in my book. Let's go down here and ask this question. Isn't the pre-money value that drives share pricing way out of line with the founder's valuation? Well, again, a resounding yes. Look, this is open for discussion, but this is absolutely fixed because you have to get 133. This is what pre-money value must be in order to get the $1.33. They don't tell you what the pre-money value is. They just say, oh, you're going to own so many shares based on 400,000, $1.33, and la-di-da. So remember from our other analysis that generally the total valuation or founder valuation is almost always greater than what the investors are willing to pay. This is just the opposite, and it's so bad it's almost 5 times what this number is. Now, and the last question is, aren't you paying too much for too little? Is there any juice left in the deal for you? Well, what we've actually done is I doubt there is any upside potential because they have fully priced it by virtue of this huge pre-money value. Now, let me show you something. If they had had a pre-money value that was more in line and they dropped it and dropped it and dropped it, I'll show you what a deal might have worked. Let's give them a $2 million. Okay, we'll give them a little bit of lagniappe. But if they had been reasonable about it, they might have closed the deal. $2 million is now about a little less than 40% of the share. Now it starts to get interesting, even if you do a $10 million sale. There you go. Now that's a 42% internal rate of return and 4 times your money in 4 years. Well, okay, that's starting to be reasonable. It's still overpriced. I mean, why should you pay double what a professional investor would never think of doing? Just because you have a small amount of money, do not think you are not a professional investor. Be tough. Don't take these overpriced, inflated deals. To underscore that, I'm going to read this little disclaimer. We are on everybody's stupid investor list, just so we can see the bad deals. Hardly a day goes by without a call from the telephone guy hyping a fabulous business opportunity. We usually get the documents and are not surprised that 9 times out of 10, they are terrible deals. The business proposition is, of course, supercalifragilisticexpialidocious and not properly priced for the risks going forward. The greed factor is incredible. Overpriced, overpromoted, burdened by upfront fees and commissions, and where sometimes only 50% of the money raised actually goes into expanding the business. There is no way the investors will make out on these deals. Nearly all returns accrue to the promoters. Our advice, swim, swim, swim away, and keep your arms and legs by virtue of using shark cap table fast. Thank you.